Hello, welcome to class, and today we'll be talking about financial instruments and fair value measurement. Financial instruments and fair value measurement. And under this, we will look at the classification and measurement of financial instruments, financial assets and financial liabilities, impairment of financial assets, hedge accounting overview, fair value measurement and hierarchy, and disclosure requirements. We will look at all this briefly. Financial instruments are fundamental to modern business operation and financing, and this module covers IFRS 9, which deals with the classification, measurement, impairment, and hedge accounting, and IFRS 13, which deals with the fair value measurement. And the IFRS 9 replaces the incurred loss model with an expected credit loss model. And the IFRS 13 provides a unified framework for fair value measurements and disclosure. Based on classification of financial asset under IFRS 19, classification is based on two criteria. One, business model, which is to hold to collect and sell and order. And the second is the contractual cash flow characteristics, and this is the SPPI test. And the SPPI is solely payment of principal and interest. And we have the measurement is categorized into three. The first is the amortized cost. The second is the fair value through other comprehensive income, and the third is the fair value through profit or loss. Let's briefly look at the business model and the SPPI test. Business model example include the hold to collect, which is loan held for interest income, and RSAs, and this amortized cost, and hold to collect and sell, which is managed for both cash flow and sales, and this is fair value for the comprehensive income. And others example include trading, and for this it's actively traded for short-term gains, and this is for FVTPL. And for SPPI test, it's passed when fixed or variable interest payment linked to value and credit risk, and it fails when payments linked to equity price, commodity, or leverage interest rate. When payments are linked to equity price, commodity, and leveraged interest rates. For the expected credit loss model, it's replaced by the IFRS 9, IFRS 9, and the IFRS 9 replaces the incurred loss model with the forward-looking ECL model, and this is in three stages. The first one is the low credit risk, which is recognized in 12 months ECL, and second stage is the significant increase in credit risk, which is recognized lifetime ECL, and the third is credit impaired assets, which recognize lifetime ECL, interest on net amount. And a simplified approach is trade receivable use lifetime ECL from inception. The hedging accounting under the IFRS 19. Hedge accounting reduces the profit and loss volatility by matching gain or loss of hedged items and hedging instruments, and this can be seen in three types. The first one is the fair value hedge, that is hedge changes in fair value or recognized assets or liability. The second is the cash flow hedge, that is hedge variability. It shows hedges variability in future cash flow. And the net investment hedge that is hedges foreign currency exposure of foreign operations, and the criteria for this is formal documentation, economic relationship, and effectiveness assessment. For fair value measurement, which is IFRS 13, fair value is the exit price in an orderly transaction between market participants, and this actually has hierarchy, which is fair value hierarchy, and this is in level 1, level 2, and level 3. For level 1, quoted price in active markets, which is highest priority. The level 2 shows an observable input other than level 1, which example include yield curve and credit spread. And level 3 deals with the unobservable inputs, which is the DCF model and entity estimates. For valuation technique, there are 3 major approaches under IFRS 13. The first approach is the market approach, which uses price from comparable market transaction. We also have the income approach, which uses discounts future cash flow to present value. And for cost approach, it reflects current replacement cost, less common for financial instruments. An entity must maximize observable input and minimize observable unobservable input. And for the disclosure requirements, IFRS 7 requires disclosure on significance of financial instruments, nature and extent of risk, the hedge accounting effect, and for IFRS 13, it requires fair value hierarchy breakdown, level 3 reconciliation and sensitivity analysis, and evaluation techniques and input used. Looking at a practical implication, the ECL model requires robust data, forward-looking information and judgments. The hedge accounting aligns reporting with risk management but requires rigorous documentation. And the fair value measurements for the level 3 assets involve significant estimation and disclosure. An ongoing challenge include climate risk integration, crypto assets. In conclusion, IFRS 9 and IFRS 13 provides comprehensive framework for financial instruments, accounting, and fair value measurement. Having a mastery requires understanding classification, impairment, hedge accounting, and valuation techniques. And transparent disclosure are essential for users to assess risk exposure and measurements uncertainty. And a continuous learning is necessary due to evolving standard and emerging financial innovation. Thank you.